Hey there, my name's Ryan Dossey, and in today's video, I want to talk to you about what we're doing as real estate investors in the current market and why I think it's something you might want to follow along with. This first section of today's video, I want to talk to you specifically if you're actively investing already. If you're on the sidelines or wanting to get started, don't worry, I'm going to give you advice too, but kind of this first couple minutes is going to apply just to the guys and gals like myself that were already in the trenches. We're doing flips, we own rentals, we're wholesaling, etc. I was listening to a recent podcast from Andy Frisella about their experience growing First Form during like 08, 09, 2010. And he said something that really stuck with me that I think we've already started to see the signs of. The businesses that pause their marketing, scale back, lay people off, like try to like put their head down and wait out the storm, none of them made it. The only reason they're still in business today and are the size of business they are is because they doubled down on their efforts. That doesn't necessarily mean spending more on marketing. I can tell you we are spending more on marketing, but it means getting super focused on working your leads, working your relationships, asking for referrals. Somebody calls in and says, hey, take me off your mailing list. Hit them with, awesome, I can do that. Do you have a different property you want to sell? Or do you know somebody that's going to be selling soon? Like literally maximizing every opportunity that you've got. I think the kind of days of like cherry picking leads and just waiting for a motivated seller or a laydown are going to end up being like somewhat over. As things come in, you've got to be just ruthless in extracting the results out of your business. That's going to go for marketing channels. That's also going to go for employees. It's also going to go for like vendors and service providers. If something's not generating an ROI, you need to cut it. But flip side, if it is generating an ROI, it's something you need to double down on. The second thing I want to talk to you guys about is what I'm personally doing and targeting. Now that we've kind of got the like mindset chunk out of the way, I always like to give you guys stuff that is super practical and actionable. So we're personally marketing to kind of the first and second time home buyer asset classes in our metro. We're also specifically targeting the ones that are at or below the like average price of a property in our market. So in our market, that might be like 300 grand. We're looking to do the deals that are like 250 and below. My kind of thought process with this, as interest rates are rising, which it's no secret they are, people are going to get priced out of like the McMansion-y property on the golf course kind of stuff, but like they've still got to go somewhere. If you're in a 2-bedroom house and you find out your wife's pregnant with twins, like it's probably not going to work. You've got to upsize if you're moving for work. Like there's these things that just you're going to have to buy. Well, what are those folks looking at? If they were looking at the $500,000-$600,000 home and interest rates aren't really working for that anymore, they're now likely looking at the $300,000-$400,000 home, which we'd be in the price point of. The other kind of flip thought to this, if somebody's wanting to go from living with mom and dad, or they just graduated college, they're looking to buy a house, or they're tired of renting, they're going to be looking for this first, second time home buyer-y kind of asset class. We call these vinyl villages, but they're typically 3 bedrooms or more, 2 bathrooms or more, over 1,000 square feet, attached 2-car garage, and kind of the like Stepfordy neighborhoods where everything looks the same. That's what we're going after. It's what we're doubling down on. Simply for the fact of the matter, it's what people want as rentals. It's what people want to own. So if I can find the same inventory that Open Door and these other giant hedge funds are going after, but just get substantially better deals, that to me feels like a really safe play. We're looking at places that are like in good school districts, really making sure we're going after like the kind of stuff that people are wanting. And on that end, our cost per deal is likely going to end up being a little bit higher. However, the return should also be higher, or the return is higher from what we've seen in our own efforts. The third thing I want to talk about with kind of just where the market's at is like, look at me. I'm not 40 or 50. I haven't been through multiple market cycles like a lot of investors have. In fact, I think a lot of the folks that likely follow my content are in a similar boat. They maybe started in like 2011, 12, 13, 14. And we've had just this crazy upward swing where now we're going to kind of see who knows what they're doing and who doesn't. As part of me trying to make sure that I'm set up appropriately for just where we're headed in the market, I've reached out to people that have been through '08 or dot-com crash or kind of some of these similar events of like, hey, what actually happened? What was it like? Not only that, but like, how did you feel about it? It's really funny, man. I'm seeing investors post these quotes that are like, when people are fearful, be greedy. And when they're greedy, be fearful. Like, that's a great like Instagram story to share, like, high five your bros with. But actually having the cojones to be the guy that doubles down on your marketing when everybody else is shrinking back is a totally different story. One of the guys I interviewed is a gentleman by the name of Eric Lundberg, owns the domain houseflipping.com, which like solid domain there. Real estate investor, owns a RIA. So they're flipping about a house a week right now, which is pretty solid. But they've been through 08, 09, 10, all of that. And I actually pulled him in for our community CCF just for us to ask him like our honest, fearful questions, right? Like we haven't done this before. What should we be expecting? So he used this phrase that I hadn't heard before, which actually sounds awful, but makes a lot of sense, which was flipping houses during kind of that time frame was like an auction at a beauty pageant, which by that, what he means is you've got to have the nicest, prettiest product for the price point that you're in. People get very particular of if I'm going to buy a house right now, it's going to be one that's solid. It's actually kind of a change we've started to make in our own flips. Historically, they've all looked the same. It's been kind of builder grady, gray, white, agreeable gray type of a thing. Carpet, vinyl plank in, bathrooms, kitchens, hallways, carpet like islands in the bedrooms. What we've realized is, okay, we need to actually put a little bit more effort into our design where these places look a little bit more inspiring. So just kind of something to be aware of if you've been like lipstick on a pig kind of flips, like you're probably not going to be able to get away with that when people aren't dying to get in just to get in. The other thing he said that, made me feel good was he agrees with our strategy. It's the same thing they're doing of targeting that particular asset class because it's not likely to go down a ton. It's also not likely to go up a bunch. Whereas stuff that's like super high end, it's going to get harder to sell. Stuff that's super low end, people might be avoiding. So that's kind of just our approach. These like newer, nicer places that need smaller rehabs. I'm really not taking on any like massive projects unless they have stupid margins. We've got one in St. Louis we bought for 180. We're putting like 80 grand into it and it should go for like north of 400. I'll do that deal all day long, but I wouldn't do that deal if I thought I was only going to make like 30 grand, if that makes sense. The fourth point I want to make is, are you an investor or not? As an investor, your focal point should be ROAS. It's likely not a term you're familiar with, but that's return on ad spend. It's how every marketer tracks whether or not they're doing a good job. Being an investor is the exact same. If I spend, let's call it $7,500 to get an off-market deal on marketing. Now that's really high. That's way more than we're typically seeing. But on that deal, I make $35,000. Even after I've paid like my acquisitions guy, I've reimbursed myself for marketing, I have a stupid return on ad spend. I don't know if you guys hold crypto or stocks. I've got like a percentage of my liquid income that comes in that goes into both. And I think my stock portfolio as of this morning, when I looked year to date, is down something like 24%. Crypto, I wasn't hit quite as bad on because a lot of what I had was held in something called PAX, which is backed by gold. So it doesn't go up a ton, doesn't go down a ton. But even still, I think, I'm down by something like 10, 15% there. Flip side though, I've only got to do one or two flips. It's kind of funny. I said flip side. I've only got to do one or two to literally have recovered that money that, lost in the dip. Now I'm not selling, and I am dollar cost averaging, meaning I'm continuing to take that percentage of my liquid income and it is going into those assets still. even if they might continue to drop. That's what dollar cost averaging is. I'm not trying to time the market. I'm consistently putting into the market. Now, I'm being maybe a little bit more picky with like what I'm putting into what, but that being said, if you're an investor right now, it really shouldn't be like, oh my gosh, my cost to get a deal went from $2,500 to $5,000. If you're making $25,000, $30,000, $40,000 on that $5,000, like if you're an investor, you should be happy with that. So I guess what I'm getting at is just make sure you're focusing on the appropriate metrics. Tracking like, oh my gosh, my cost per call went up, right? I was talking with somebody recently and they're like, my response rate's down. I was like, okay, what's your return on ad spend look like though? Yeah, me personally, I haven't really super cared about like what my response rate is. We definitely track it to make sure we're headed in the right direction. We're getting calls and all that good stuff. But at the end of the day, if I get a 15% response rate and a 0 return on ad spend, am I really proud about that 15%? Heck no. I would rather get a 1% or a 0.5% response rate, but get a 2, 3, 4, 5x multiple on my cash. That really should be the goal. So the fifth thing I want to talk about, this video, I'm not a doom and gloom, sell everything, go buy gold and Bitcoin. Like that's not my angle. I do think if you have adjustable rate mortgages that you're going to need to refinance in the next year or two, might want to do those sooner than later. I do think if you bought deals that don't have equity, that don't really cash flow, you might want to try to exit that. I do also believe if you're buying properties at a discount that are in areas you believe are likely to appreciate, that cash flow, you really don't have a ton to worry about. Not saying rents aren't going to go down or we might not hit a recession. I'm not saying that, but I'm also not saying the opposite. In my opinion, I think it's going to be very, very localized. I think the people in Nashville that are hoping properties are going to crumble where they can buy an A-class house for $200,000 or SOL, it's probably not going to happen. Flip side, I'm probably not going to be able to go buy, a mansion on the water in San Diego for $1 million now either. Like it's just not going to dip that hard. There's going to be other markets though, like if you're in a town that only has one manufacturer and that manufacturer goes under, yeah, you might have some problems. So keep an eye on your own local market. At the end of the day, the best thing we can do is make educated decisions based off the data we have at hand. So for us, we're going to dollar cost average in real estate. We're doing flips, we're still doing wholesales, but we're focused on getting good deals at a substantial discount, 25% or more. I will say now is not a point in the market where I'd be like, I've got to be at 87% of ARV or anything like that. And we're holding the ones that are in areas we think will go up in cash flow. We're flipping the ones that we don't think will cash flow. That's really our approach. It's our business model. It's really straightforward. I hope that you took the time to enjoy this video. I'm not going to sit here and pretend that I have a crystal ball. What I am going to do though is acknowledge the fact that I'm in the market. I know how to make money in the market. I know how to buy properties for substantially less than what they're worth. In fact, on a typical deal for me, the market would have to dip by 25% during the time I own that flip or that particular asset for me to break even, not even lose money. Historically, the areas I'm in, the asset classes I'm in haven't done that. So this is what we're focusing on. I've got staff, right? I'm not going to pull back and operate from fear and just say, hey guys, sucks to suck. We're going to keep doing what we're doing. And fact of the matter, just if I'm being blunt, our last 3 places have sold in less than 48 hours. A couple of them have gone for over asking and for cash. So if you know what your market wants and you go find it, in my opinion, it's kind of the best business plan you could have right now. Thank you guys for taking the time to watch today's video. Again, my name is Ryan Dossey. Be sure to like and subscribe if you found this helpful. I'll talk to you next time.